Welcome to another episode of the SwingTrader status update, weekly status update. Did we go with that? You know, it has kind of that SNL vibe to it when we go there.
Yeah, I like that.
I like the weekly status update. So it's just Nielsen here along with Mike Webster, and we've got Dominic in the background. It's August 20th, 2024. It's a Tuesday. And 1 week ago, Mike, we were talking about the follow-through day that we didn't want. Do you want it now?
Well, we got it, whether we wanted it or not. No, we did not want it in that position. This has been so tricky and so unusual, but we do have some historical examples we're going to look at, where things like this have happened in the past to, use that as our guide. But no, we didn't want that follow through day, but we got a few more after that. So, what are you going to do?
Yeah, and I feel like that kind of really changed the tone because I mean we had this wedging that was one of our big concerns. I'm going to go ahead and pull up the S&P 500 chart just as an example here. We had kind of and let's describe wedging again. It's when you're kind of going up along your lows, but you're not making very much progress. And usually, Bill O'Neill, the founder of Investors Business Daily, would say, "Hey, you need some type of shakeout when you see that action." Arguably, you could say this was kind of a shakeout, but it didn't undercut the lows. So it was like, so yeah, we wanted a shakeout. And then the other thing was, when we spoke last on the weekly status update, it was right ahead of the CPI report, and having a follow through day on a PPI report, but right ahead of that CPI report did feel a little unnerving. Like, do you really want to stick your neck out when there's so much volatility that can come away from these economic reports? So that was kind of the double whammy. But as you said, Mike, we've gotten multiple follow-through days since then. August 13th, of course, was the day of the follow-through day. And since we're on the S&P 500, I'm just going to point out that the next day we had a break above the 21-day moving average line, where not only did we close above it, but the low got above it. Then we had another, what we call a subsequent follow-through day, and that blasted the S&P 500 with the low above the 50-day moving average line, also this important 5,500 number. And then, although yesterday fell short on the S&P 500, I'm going to go ahead and flip over to the NASDAQ and kind of say, hey, we kind of had a similar thing. We had the 13th with that, strong, powerful follow-through day. A couple days later is when we got the break above the 21-day line there. We haven't gotten the low clearing the 50-day moving average line on the NASDAQ yet, but we did get that subsequent follow-through day yesterday with heavy volume accompanying a big gain. So that certainly, that power kind of does change things, right?
Yeah, it does. And just kind of going over a few of those points. So our low is above the 50-day on the NASDAQ, but the way we like to look at it is it's not really above it until the low is above it and you close up on the day. So we close down a little bit. So today we're not saying we're really technically above it in the way that we like with the restraints that we put on there, but it feels like we're above it. And let's go back to the S&P, because we were talking about this a couple hours ago, that yesterday, we were up, I think, 0.97%. And for a subsequent follow-through day on SPY, we would need 1%. So if you round it, it got there on the price aspect of it. But of course, the volume was light. So no matter how you slice it, we've had a bunch of buy signals ever since, original follow-through day. And as you were pointing out, that on that follow-through day, the next day, we had the CPI, but even worse, we were underneath the 50-day. So in that position, when you come up there, that's where people like to short. So this was not an easy one, but that's why we use the black and white rules that we have to kind of gauge how deep in the market that we go. And that's what we've been using to get us in deeper than we really feel comfortable with, is the market school rules that both of us came up with Charles Harris 13 years ago or whenever it was, where you don't do any thinking. You just say, okay, did this trigger or not? Is your low above the 21-day and up on the day? Then it's a buy signal. Did you get a subsequent follow through day? It's a buy signal. So when you added up all of those, basically put us, where our exposure should be, about 90%. And we're roughly in that ballpark. Feels very uncomfortable because of where we just came from. But that is why we develop those rules, because sometimes you have to do things that are out of your comfort zone. And so in a moment, we'll go back and look at some historical examples and just show how you do have to force yourself out of that comfort zone, because sometimes they just keep going. And if you wait for that pullback, the pullback sometimes doesn't ever happen.
Yeah, good point. I do think it's also worth mentioning that we have talked about this follow through day that we had on the S&P 500, and big expectation breaker the next day, downside reversal, outside day, closing at the lows. Nothing good about that day right there.
Yeah.
But why it's important is because that was kind of a line in the sand, and we have gotten above it now.
Exactly. And I kind of view these, it's a little easier to see on NASDAQ. So let's toggle back over there, or even the Qs for that matter. Yeah, let's go to the Qs. That it feels like a double bottom in here, where the middle, where that expectation breaker was on all of them, that was your midpoint that you were just pointing out. And so we're over that threshold, or over that pivot. Is this an ordinary double bottom? Not at all, but it's in that vein where you hit one bottom, you go up, you run into some sort of resistance, you come down, you undercut the original bottom, which we did in a big way, and then you come up in a powerful fashion. And that's what double bottoms have in common, is really that last move up from your second bottom doesn't meander. It should do exactly what it's doing right now. It should be catching people off guard, catching people really off sides, probably short or light in the market, or in cash, and then having to chase it or to cover your shorts. So that's the position we're in right now. And we stalled a little bit, or had a little mini downside reversal today, depending on how you want to look at it. So should we come in for a couple days? That would be normal and natural. Tomorrow, of course, we've got the Fed minutes that had come out late in the day. But then really what everyone's waiting for is to hear what Powell has to say on Friday. At this point, given the data that we have, my best guess, and it's just a guess, is that Powell is not going to say anything other than to hint towards 25 basis points 3 times this year. That's what I'm guessing. I think that's what most people in the market are guessing. And anything that is different from that, either more hawkish or more dovish, that would move the market. I think if we get through that speech and he doesn't pull anything strange out, we just really don't want any surprises. We want it to be boring, and then that could allow the market to continue to lift. And frankly, we could be at new highs before you know it, which just feels strange, right?
The S&P 500 is almost already there. I mean, it's Ali and I were joking yesterday on the SMT video. It's not shouting distance. I mean, this is like almost whispering distance. At this point. Another thing that's worth mentioning as we were looking at the Qs, that as you mentioned with that double bottom, it is interesting that we came up. If you're calling this a double bottom, for that middle of the W, we came right up to that 50-day moving average line. So as you were saying, that position of having this follow through day underneath the 50-day moving average line, you could easily have seen it come up to that line and get turned away again. But that's where you have to kind of sometimes wait and see, and not go too heavy too fast until you kind of start really triggering these further buy signals.
Exactly. We were kind of like dragged into the market by our buy signals. And that's why the three of us came up with those rules, because, you don't need these types of rules when you're in the zone and everything's working and the market is easy. You need it for when it's tricky and the market is hard. You need to be able to lean on something that you trust. And I think the three of us really trust it, because we know it's not perfect, but we know it's the best thing out there that I know of to gauge how deep in the market you should be. And that's what these rules are about. And if you're interested, there's a home study available on our website, and you can watch us, go on and on for like 6 hours or something like that about it. And it's very, I I find it fascinating, and I think it's the best work that the three of us have done. And so it's pushed us in the market, but it'll also push us back out of the market if we start triggering some sell signals, like, closing back below the 50-day. That would be a sell signal. Closing underneath the 21-day. That would be another one. A major one would be closing underneath the original follow through day that we had. If we close underneath that low, that would really be a major break. So you don't have to wait until you get all the way down to the old lows before you know that there's problems. That is our line in the sand. And I would say a test of the 21-day, that can happen at any point and be normal and natural.
Mm-hmm. We can take a look at some of the precedents
Sure.
that you were looking at,
Yeah.
but let's go ahead and go back in time, and I'm going to go ahead and I'm going to start with the 80s. We were talking about this the other day. Some of these we did go over on the last SMT video on Friday, but it's worth kind of revisiting, because as you get more data, you start wondering, okay, is it still holding? So I think I mentioned, last time, this is very close to our Back to the Future date, in November of '85, when McFly takes his journey back. But what is it that you find similar here in this position?
First, I'm still waiting for that hoverboard. Do they have that yet? I want one. So, anyways, what I would focus your eyes on this one is the where it broke from new highs in July down through your 50, down through your 200, and then you're bouncing up, and you're in a position where you would expect a pullback. Now, what's similar to our current market, well, a lot of it's similar, is that our 21-day, which is your green line, is still underneath your 50-day, that red line. So that's what, on these examples, that's what I would focus a lot on. And also, what would your expectation be at that point? Your expectation would be a test of the 21-day, certainly a test of that, at least a test of the 200-day, which is your black line there, or just completely rolling over. So this is what it looked like at this point. That's what you would be thinking would be normal and natural. Now let's go out to the next date and see what it actually happened.
So we're going to go out to April 16th, 1986.
Mm-hmm.
I mean, it is kind of like Back to the Future, where you can just change time like that, huh?
Yeah. And so point out those 2 bad days in there that where we just were. A little further over to your right. Yeah, right there. That's where, or they weren't really bad days, but down days where you would have thought that you would have come in, and you never did. So what is the learning lesson from this? Stocks in the market can go a lot higher than you think before they eventually have a pullback, and they always do. What do you learn? You learn that the low versus your 21-day, that green line, is the key to keep you in and keep that accelerator down, even when you don't want to, or you're scared to, because the market is telling you that there's something it's seeing out in the future that's saying that the coast is clear, at least for a period of time. And so that's what's going on here. And if you just didn't do anything else but just listen to that 21-day, it would have forced you in that market, and it would have kept you in the market. And that's what we're doing at this point. We're being relatively aggressive in the market because of these types of precedents.
Mm-hmm. Let's go ahead and go to our next example, and this is going to be fast forwarding to 1998. Again, this was kind of at the beginning of my investing career, I started in September of '97, and this was where I had finally kind of gotten a hold of the rules. I felt like I was learning stuff and understanding, and then this whole follow-through day concept got turned on its head for me a little bit as I invested in September, only to see this roll over, very quickly, make another low. And personally, when this follow-through day and this subsequent follow-through day came in October, I was like, oh, you can't fool me this time. And it was a while before I got into this market. Of course, as a backdrop, you also had Russia defaulting on its debt, ruble, going through a tailspin. A lot of the Southeast Asian currencies were getting all messed up, and the big daddy of them all was how many of these things affected long-term capital management, and this was in danger of bringing the economy down with it. One of those too big to fail institutions. So Greenspan, after Buffett and others, had a deal out on the table that was not taken advantage of, Greenspan eventually had to step in with the Fed and do a bailout. So on the technical side, and I mean, you could say that there's some similarities in terms of August 5th, yen carry trade, Google antitrust, unemployment looking not so, great. There was a sky is falling type of feeling that day on August 5th, but talk about a little bit about the technical action here.
Yeah, so the news was terrible during that bear market. I think it was like down 33% or whatever in a blink of an eye. And the news is always terrible during a bear market. And it's always terrible when the market bottoms and starts going up. And that's why, Bill recognized that before both of us were born and came up with the follow through day system to force himself in the market and knowing that the news isn't going to be good until, sometimes months later, or even a year later sometimes. So he was just following the system. He did extremely well, some of his best trading ever during this time frame. And for our purposes, what we're looking at is just think about that mindset that you would have had during that time. And it was scary, and it could have gotten a lot worse. Didn't have to bounce back. But again, we're going to focus on that green line, the 21 day. This point is still underneath the 50-day, but your low has gotten above it. You have a little mini downside reversal on this day, kind of like what we had today. Your expectation is, okay, you've run up so much from the bottom up to here. Normal and natural would be a test of your 21 days, certainly a test of the 50-day. But let's see what really happened.
Okay, and we're going to go out to, let me get my notes here. We're going to go out to just a few months later, actually, to January.
Prince's favorite year.
Yes, party like it's 1999.
And so obviously the market continued a lot higher from here, but we didn't want to go out too far. And again, notice the low stayed above your 21 day that whole time. That is a powerful market, and one that you don't want to be in there going, okay, it's gone too far too fast. I'm not going to buy yet. I'm going to wait for a pullback. Because again, the pullbacks tend to happen much later in the move. And then at that point, you're capitulating and you could handle that wrong. So again, a reason to kind of force yourself in as long as your low is above that 21 day. And of course, if you're in a position where you needed a follow through day, which we did here, having that is critical. And I think we have one more.
We do. So we're going to fast forward to 2016. And this was actually right around the time of the election, the presidential election. Now, we don't need to get into the politics of it. We can, just kind of say, hey, look, there was some uncertainty. News was coming out, and it was like, okay, who's going to win? Hillary, Trump, there was a little back and forth. But talk about the technical side and what made you think of this one.
Yeah. So, and I think we both thought of this one, frankly, when we were talking about this a week ago.
Yeah, I mean, we were talking about Brexit,
Yeah.
first earlier in the year. That was here in June when that election happened, and it did have that sky is falling type of feel. And then people were like, wait, this isn't going to happen for a long time.
Yeah, and I remember that fear that happened and that gap down on the Brexit over there. I distinctly remember where I was when I heard about the vote and everything. But again, everything shifted and your low got above the 21 day shortly after that. And then you had a nice trend for a while until you got close to that election. And again, we're not talking politics here. We're just talking the expectation was one outcome and the reality was a different outcome. So people were, thinking that the initial thought was, if he won, it'd be bad for the market or bad for the economy, what have you. but the market always sees through and saw the tax cuts and deregulation and everything. And let's go out. Well, again, before we go change the date, again, the 21-day is still underneath the 50-day here. Of course, it wasn't as big of a break as what we had recently, because it didn't get down to your 200-day, but still your green line is underneath it. And your expectation at this point is, wow, that's really sloppy, especially the day, 2 days before with that wild action. Probably a test of 5,000 is what you would think. And let's see what ended up happening.
So we'll go to March 1st, 2017.
And again, this one didn't trend as nicely above the 21-day as some of the other examples, which is why we wanted to share it with you, is that you can have those quick breaks of the 21-day and you have to adjust, because sometimes, even though that first one that you marked was, 2 bad days and then you bounced, lots of times there's 3 days or a lot of time in there. So you just wait and see how it comes and wait for that low to get back above the 21-day before you start pressing on the gas. And it did, and then it had one more pullback, and then we got above it and stayed above it, and it trended nicely. So it's not always so easy that it stays above it in this perfect way like the other two examples, but you do need to adjust with it. And again, if you don't do anything other than look at the 21-day exponential, I think that'll save you a lot, and also force you in the market, and it'll push you out of the market.
And one other thing, just on the election side of things, sometimes it's not even about the whole market. What is it going to do? But sometimes there are certain sectors that seem to favor a certain candidate or disfavor a certain candidate. And I mean, one of the things that was notable after this election was the huge move in the small cap Russell 2000 index. It didn't last, but it was, pretty noteworthy.
That one never seems to last.
Right, exactly. So anyway, that's our kind of look back at the past. Coming back to the current situation, we didn't talk about the Russell 2000. But it's probably worth mentioning, since we just mentioned it back in 2016. This did have, that July 11th we talked about, where it was, rofaction no more. It seemed like, okay, now it's for real. And then it was, I mean, you can't deny this power that the Russell 2000 had, but it just didn't last. It came right back down, underneath its 50-day moving average line. Now, this hasn't looked as strong as the NASDAQ composite or the S&P 500, but it has gotten above its 50-day moving average line. It has gotten above its 21-day moving average line. And because of this activity over here, the 21-day is above the 50-day line. Is this worth looking at?
I don't think so at this point, because of that last head fake. I'm not saying I don't think it's going to work. I would just like it to simmer down now, as we said the other day on IBD Live. Just settle down, build something, some sort of technical pattern that makes sense. This is not a normal technical pattern. Or the low just stays above that 21-day for a little bit of time. So if that happens, then we could start inching into this possibly. But if you go out to the monthly on this one, for some reason, and I have what I think, but it doesn't matter what I think. It's the reality is this one just doesn't want to go anywhere. And even though it's moved up, if you look at that relative strength line, the history of it, it versus S&P, and it just can't outperform other than these little blips that it has. And so we won't get into the why, but just the reality is, until that RS line starts poking, let's go back to the daily on it. Until that starts trending up again, like it did there for a bit there in July, and it was looking really good. Like the distance that RS line got versus its moving average was massive and so unusual. And frankly, you always want to be intellectually honest when you go back and look at past trades. And I was very bullish on IWM and the small caps and even the mid caps. And I would do with the same information, I'd do that same trade over again, because that RS line, doesn't lie, but sometimes it can just mislead for a little bit. And so there was a big pocket there, but then with all the uncertainties around the yen carry trade and really the economy, maybe doing a hard landing, and then what the Fed being behind the curve and all of that mess, that it really killed this one.
Yeah.
So I just think it's in the penalty box, because I think a lot of people like myself got burned in that trade, and you just need a little bit of a timeout.
Yeah. And, a lot of times Bill would talk about, like, if you have a big gain in a stock and it retraces everything, that's a flaw.
Yeah.
Let's turn our attention real quick, just to kind of wrap up the market part. This is your 50% retracement. So
Okay.
maybe talk a little bit about why you're looking at this and what it is that you're why it's important right now. Because we're obviously, I mean, as we said, SPY is almost at new highs. We're obviously in the upper part of the 50% retracement. But why are you still looking at these levels?
Yeah, so I look at them, and prior SMTs, we went over, shorter term, 50% retracements, medium term, and then this was the longer term one where we went from our ultimate high on July 16th, down to the low on August 5th, and then we're looking for the midpoint. And we were looking at that back when it was under here, and saying, okay, we need it once it gets above here, then you know that you're in a position of strength. Because again, the 50% retracement philosophy that I use is that anything can retrace 50% of its move, either move up that comes back down 50%, or a move down in this case that goes up 50%. So you don't know until really this day, August 13th. You didn't know that was for real until you at least got above your 50% marker, which is the 537.72 on SPY. Now, getting above it is one thing, staying above it is more important. And now we've been living above it. We didn't even have to get up this high for us to be comfortable from a 50% retracement standpoint. We just needed to be staying in this general area. So that one is quite a bit stronger than the NASDAQ, which still has quite a ways to go. So even though NASDAQ has bounced more than SPY has, like from a percentage standpoint, that's just because it's a faster moving instrument. But it still has further to go to get back up to these old highs. So the key level that I'm looking at is, and it's not the specific level because most people don't use a 50% retracement. It's more of a feel type of thing. So really like 17,200, 17,100 is the level that I'm looking for it to stay above. The official number is 17,189, but really in that general ballpark, that's where you want it to be living above, and it is so far. So if we do have a pullback, it's not like a 50-day or a 200-day where it's going to stop and get support there. You just want it generally living above that area, and if we never come back to it, that's even better.
Mm-hmm. Let's talk a little bit about stocks and the positioning
Sure.
there. And maybe what we can do is we can start with a pie chart to kind of get a sense of where we're at right now. And this will take just a minute to pull up, but we'll start with the pie chart and talk a little bit about how it seemed like there was this defensive side of things. I mean, XLU was looking like it was set up. There were a lot of things in this rally that seemed like they were, even XLP, they were looking a little bit stronger. But now it seems like growth is kind of catching on a little bit more, a little bit more movement in that tech. Part of that is, as you said, NASDAQ coming up stronger, doing the bounce, but what's kind of your take in that regard? And Dominic, if you can go ahead and throw the
I
pie
think
chart
he's
up.
having trouble hearing us. So I'm going to send something in our chat.
Okay.
Pull up the chart. So to your point, while we're waiting for that pie chart to appear, is you have this major shift, out of the hot stocks into the slow stocks, into the safety type of names. And then, their relative strength line was really, those were, the slow things were really ramping up. And then as we got the follow through day, that kind of shifted. And then it went into the fast names because those were bouncing back and recovering and kind of doing a mean reversion trade. So you kind of had a mini version of what had happened with the Russell, how the Russell had fallen so quickly. It was the same thing. The slow pokey stocks, when we get back to the normal charts, we'll take a look at that XLP and see how that, the RS line was, coming in while the stock is still going up, or that the ETF is going up. Basically a sign that the slow stuff are moving up, because everything's moving up, but it's just a lot slower than the Qs or even the SPY. So with this pie chart, we're kind of spreading things out for now until we can feel more comfortable about what is truly going to lead. So we have some heat in there, and we have some slow pokey stocks. So we'll have a Service Now, and we're balancing that out with a Costco. And then, if they both go, we'll hold them both. And if one of them starts to fade, we're going to blow that one out or reduce that one and just go with what's working. So it's not clear yet. Right now, this week, it feels like the heat is working, but it can change. It's certainly not like the slow pokey things are looking bad. It's just that they've slowed down and they're just inching up, whereas all the other things are bouncing quickly. Certainly chips, we've got the Broadcom that we put on there, and that one looks like it wants to go. I do have a position in that as well. So that's all I have to say about this pie chart. It's spread out for a reason right now until we can get some traction and know what's working. Then we'll just slowly start, peeling off the ones that aren't working and add to the areas that are.
Since you mentioned Kava, let's maybe switch over there. I'm going to just jot a note.
You want to let him know?
Yep. So poor thing can't hear us, and he's trying to produce this thing. So that's a challenge. So
we like to keep it fun.
Exactly. Challenging. So here's Kava, and I do have a position in this myself.
So do I.
Earnings are coming up on Thursday after the close. So 2 days away. We've got a nice cushion on this. We've reduced this down to a quarter. So before, we were pretty adamant about, we're not holding through earnings because, as swing traders, the potential loss that could happen after an earnings report was just untenable. It could get you too big of a loss. And when you're taking small gains, it just, the math wouldn't work out. But if we're going to try and hold on to some of these things for some bigger gains, then we might be able to hold some of these through earnings. Now, we only have a quarter, so it's not like we're going full bore here with Kava, but maybe discuss that a little bit. Why the change?
Yeah. So one of the things is just looking at what's worked and what hasn't worked. And, Leaderboard, our other product at IBD, has just been kicking butt, for this year. And one of the ways that they were able to do that is holding stocks through earnings, especially NVIDIA, which we both have positions in, that was able to have this monster move. And they've just done a great job with it. And that's where a lot of these gains happen, is sitting through earnings. Now, that is the big problem where, when you're swing trading, you don't really sit through earnings announcements. In this case, because we're up about 10% on it, and the market maker move on it, basically the suggested move up or down on earnings is about 10%, that we're kind of in line, and we've booked a little bit of the profit on there. Like you said, it's just a quarter position. So 2.5% position in there. So we're probably going to take that risk going into earnings. We don't know. Because we still have some time before the earnings. If the stock starts acting funny, we'll just exit it and then be ready to get back into it. And that's fine. But at this point in time, we just want to let people know that is our intention. It's a bit unusual. So if you don't feel comfortable holding into earnings, certainly don't. You can exit those. And the reason why we're doing that is we want to have some low cost basis shares in hopes to add to it if it has a positive earnings announcement. Now, if it has a negative earnings announcement, like let's pull up Bros, which is in the same Dutch Brothers, which is in the same group. And if it has something like this, obviously we're going to exit. That's how it went into earnings and at that big gap down. Now, that was in a different position at that time. That was in a position of weakness going into earnings, whereas Kava is in a position of strength. Now, the other reason why we're trying this with Kava is I'm looking at this as a market leader, a true market leader, as people like to call them, or I refer to them as a potential model book stock. Let's look at the weekly chart to kind of get that sense. And this is something you can understand versus a chip maker or some other technology where it's kind of hard to really know, is this company, is NVIDIA really that much better than AMD as a chart would tell you? Well, we just go off of the chart and some of the fundamentals on there, but you don't really know unless you truly understand all aspects of that. Whereas a restaurant stock or a retailer, it's a bit easier. People love the food there. They're always going, always talking about going to Kava and how much they like it. I just don't like their food, but that's just me. I'm kind of unusual there. My better half,
the word picky.
yeah, I'm very picky with my food. My better half loves it. So, it's a 50-50 in our household. But anyways, with this particular one, this was one of the first stocks to break out or get up back into a viable position. Let's go back to the daily. And that was poking through its 50-day right there. And that's where we were getting interested in it again, because it was the first one to go up. And that's something we learned from Bill, is your best names tend to be your first ones that gravitate up as the market is turning. And it's also one of those things that you could see that could kind of dislocate from what the rest of the market is doing, because whether we have a hard landing or a soft landing, for $12 a meal, that's probably going to be okay, because it's still fast food. It's not like it's a high-end restaurant, and it's not Taco Bell, but it's somewhere in between. So it seems like it's in that sweet spot that even if we get a hard landing, that could make it through. And of course, it's right around this round number of 100. We'll see. Hopefully it drifts down for a few days. That would be perfect. Even if we undercut the lows of the last couple days going into earnings, I think that would be normal and natural. So we're going to try to hold on to it. We'll see how that goes.
Yeah. So let's talk a little bit about the contrast between, some of these slower moving stocks and some of those with a little bit more heat. Now, of course, look, there's no free lunch here. You go with the ones with more heat, a higher ATR. It means you're taking more risk because they can move faster and knock you out with just normal activity, undercutting certain areas. And again, with our leaderboard product, it's a little bit easier to hold on to some of those and let them wiggle around. A little bit tougher to do on a SwingTrader product. And we've had a lot of wiggles and wobbles. So yeah. I'm going to pull up Costco. I do have a position in this myself. This is kind of on the slower side. So talk a little bit about the benefits of something on the slower side versus the next stock that we're going to talk about is ServiceNow, and I have a position in ServiceNow as well.
Yeah. So with Costco, the thing there, again, like the Kava, you can understand it. You can go into the stores, you can see how busy they are. You can understand the business model is really all around the membership fees and making sure it's a good experience so people don't cancel their memberships. And let's go out to the monthly on this. This has been a monster. This is a slow pokey stock that really never has major corrections unless an entire market corrects. Could we go to the monthly?
Mm-hmm.
You can just see it, just monster runs. And over time, it does tend to outperform the market, because you can see that with the relative strength line there. There's times when it doesn't, but when it doesn't, it tends to go flat. And then the times that it outperforms, it's just a mild outperformance. So let's go back to the daily on this. Why we have this in here is a balance, and it looks set up, frankly, that it wants to run up to. 90. And one of their competitors, Walmart, let's pull that up for a second, that had a good earnings announcement. Of course, they have their Sam's Club, which directly competes with Costco, and then their Walmart division is kind of separate, clearly. But that already reported, and they tend to, since there's so much overlapping, that they kind of trade relatively together, or at least their fundamentals are more in line than a lot of other companies. So that one is looking good, just not something that we have on the list right now. The RS looks solid. Let's go back to the Costco. So this is slow and pokey. And if we're wrong about the market and the market rolls over, we're less likely to get killed in this. Our risk is really around the 50-day, which isn't that far down from here. So this is a good place, in my opinion, to have some exposure. Now, the downside to this is it eats up your buying power. And so we've got 10% allocated to this. That means we've got 10% that's slowing us down this week, because you can see what that RS line has come in over the last week, really week and a half. And so that means it's outperforming and it's a drag on our performance. So that's that balance. So what we might have to do is, if this doesn't start moving out of there, we might have to start slowly reducing it down, using it as what I call a source of funds to put into some faster names. But really, I'd prefer to just keep this as a full position, and then until it starts triggering some sell signals. But if we run out of capital, we might have to dip into this one.
Mm-hmm. And speaking of which, right now we're trying to not go on margin.
Yes.
Again, we've gone maybe 1% over or something like that. Right now we're just under 100%, but we want to really kind of get a little bit more progress before we make that jump to margin, which does have its risks as well.
Exactly. So margin I think, is a beautiful thing, and it's a scary thing. And so you just have to treat it with respect. And I've always said, you kind of treat it like the ocean. The ocean is beautiful to look at the waves when you're standing on the shore. But if you're out there and you're in some like double overhead waves, it's not going to be fun, right? Or if you're out on the, on a sailboat and things are really, really bad, that's tough. So you want to treat it with respect, and there's times where you use it. So we'll use it as we start making progress. So the market has made progress, but we just haven't made the type of progress that we feel warrants going out on margin. Once we do, we'll start going out on margin. But for now, we're capping ourselves, and you always have to have a cap, whether it's 10% invested or 100% invested or 150% or anything in between. You need to have a speed limit. And that, going back to what we were talking about originally, was why we came up with market school rules that give you a speed limit to stay at. So right now, our self-imposed speed limit is 100, 100% invested. And, we won't go over that in any material amount, by any material amount, until we start making progress that we're happy with.
Mm-hmm. So let's contrast Costco, which is a little bit slower and a little outside of tech. A lot of the stocks that we originally put on had these strong relative strength lines, and they didn't do anything wrong this week.
Yeah.
They were a lot of times up or flat, tight action, which is what we wanted to see after these moves that they had. But the relative strength has gone down because, as you mentioned, S&P 500 jumping as much as it did. I mean, look, the S&P 500 and NASDAQ had their best week last week of the year. So anything that was flat or, just mildly up, the relative strength was going to be down. But let's now contrast Costco with...
Before you do that, because of what you were saying, let's go to the XLP for that point.
Okay.
And then we'll go over to the now. And this is what we were talking about before. That RS line was just smoking higher there. I mean, that is a big deal, how far that got above its moving averages so quickly. And yet...
And it's not that it was moving up high that much. It just wasn't going down with the market, right?
Exactly. And that's what, that was the issue with this one. Here recently is it's inching up, baby steps up, but that RS line is going down as fast as it went up. So that's just telling you all the money has just been moving over into the kind of the bounce back type of trade. But there's nothing wrong with this. If you just looked at the price chart, that looks beautiful. It's just kind of like the Costco. It's just the relative performance is where it's kind of killing you. So,
Mhm.
and to that point, we did put the Qs on and the spies on. We did the double version um, of those to kind of trade along with what the market was doing. So, and I think we both have I have positions in Qs and spy as well. So we can
Mhm.
go to the service now. Sorry, I got a little
Okay,
distracted.
no problem. Here's service now. The relative strength, still flattish, not out there in a tremendous way, except for this earnings really saw a big jump as the stock jumped. But this actually didn't hold, didn't do too bad on the relative strength. Support at the 50-day moving average line, very quickly back above the 21-day line and staying above this, retaking of the buy point from here.
Yeah, and it looks set up to break out above that 850.33, the recent highs, and that's the position that it's in right now. Now, if it doesn't do that and it backs away and takes out really yesterday's low, because yesterday was a nice upside reversal, we'll have to start moving out of this position. But this is one that isn't one of those kind of bounce back stocks that is extended and well out of position. This is still, technically viable up here, and so that's why we're looking at it. And let's go over to the weekly for a second and just look at the fundamentals. This one, the chart really isn't that good, but the fundamentals are great. Let's go down to the quarterly numbers. I mean, those are just stellar. Your quarterly sales. What's great about it is not just that it's in the 20%, but it's steady 20% sales growth plus every quarter. And you also have it on the earnings side as well, between 26 and 56 for that time frame. But all of them, all respectable numbers. And you can see that earnings line, that green line there, that looks solid and steady and stable. So you have a fast growing big company that's in position still. So this could certainly have a big move higher. You had PanW come out, Palo Alto come out with earnings today and with a positive reaction. Frankly, they're not direct, they're not the exact same company, but in the general space of software and security and things like that, the general theme. And with a reaction like this to a company, I would have thought that ServiceNow would have done better than it did today. So it's a little bit of a red flag, but we'll just see how things play out. And again, the point of this is just to say you have expectations on stocks. We don't know, is Costco and Costco like stocks going to do better than ServiceNow type stocks? We don't know. Nobody knows. And so what we're going to do is just play both of them, see which one works out, add to that, add to those, and the ones that aren't will start peeling away and move away. It would be
Mhm.
great if both of them can work out.
Yeah, right, exactly. And the other thing that we have to be very careful of, we were looking today, and the problem with most of the stocks, the ones that are kind of um, on our radars the most, the ones that we want to get into the most, a lot of them are extended. We have to be
Yeah.
very careful not to buy extended. Over the last few weeks, we were talking about how we really wanted to get those upside reversals, but man, the upside reversal of August 5th, it was a little, it was a little tough to be buying there because you still didn't know, was this kind of a bounce before things got a lot worse. So we couldn't really take advantage of that upside reversal. And then once it became clear, okay, yeah, this is getting some legs, then very
Yeah.
quickly, the upside reversals were gone and things were getting extended. So
Yeah.
how do you
They're
kind of
just
balance that out?
Yeah, they're just different styles of trading. So the buying the dip in that, if you can go back to Nasdaq and pull that up, on that and just look at that date, that when we were down there, I could see, I have lots of friends who do a really good job buying on the dip. And it was a logical area to buy on the dip because you were getting support at the 200 day. But we both studied crashes, we've studied history, and we know that things can get a lot worse than that. And if you buy every time, you get, a bar like that, you could have bought, and you've said it before, you could have bought like 5 times before that.
Mhm.
On other days where it looked weak like that, that's just not our style. I have nothing against it. Is you just have to kind of pick a style. I was kind of like picking music. There's different styles of music, and there's one that fits every different person. So find what meshes with your personality. So what we like to do is what Bill taught us is he wouldn't have been buying there. He would have waited for a follow through day, and that's pretty much what we did. Is you wait for a follow through day, knowing that you're never going to buy near the bottom, so you don't get that bounce back that the dip buyers get. That is the downside to this strategy. But the upside is you're also not going after every bottom along the way. So when these things drag out longer, you're not in there just getting chopped up. So there's pros and cons to every style, and that's just not our style. Our style is really when you're above the 21 day, pushing it. When you're below it, being conservative. That's kind of it in a nutshell.
Sounds good. Well, I think this is a good time to wrap things up. Hope you guys join us for our next installment next week. We'll be back doing the same old thing with a whole different market, because that seems to be what's going on. Is you wait a week and it's
what's going to happen? Because can we just tell everyone what's going to happen between now and next Tuesday? That would help.
Yeah, absolutely. And this is where it's funny, because I remember there was did you ever watch that show, The Early Edition? Kyle Chandler was in it, and he gets the next day's newspaper. I think it's a Chicago newspaper. He gets the next day's newspaper, the day before, and it comes, this cat is always there too, and you never figure out what's the deal with this cat. But man, the last few years have reminded me of that show a lot of times, because even if you had given me the headlines, I don't think it would have helped me. Sometimes it probably would have hurt me more. And this is where the chart can really kind of help guide you in terms of your risk management, all of those things. Sometimes having the headlines isn't actually that helpful. So unless those headlines told you, oh, this is what the what the market did in the last week. So
yeah, those would have been good. Yeah, because you're right. Because I think we have like PCE next week, GDP. We've got
let's
all
not
these
forget
big.
Jackson Hole on Friday.
Yeah, we've got all this, important information that's going to come out, and you're right. Like you don't know, and so that's why we're trend followers. We just do our best to follow what's actually happening in the market. And frankly, I think all of us, especially myself, would do better just not even knowing who the Fed is or what news is going to come out. It does help you a little bit into managing how deep in the market and where you're positioned, because if you're going into a big CPI number or a big unemployment number, you might have to dial things back because you could have a big gap up or a big gap down, just like earnings. If you didn't know when a stock's earnings were being reported, you might have an oversized position, and then you wake up to a 20% gap down,
Right.
Unexpected. So you have to be cognizant of it. But I think the less effort you put onto the news and just be aware of it, to put it in context with the market, like Jason Shapiro, who you've had on your podcast, I think a couple times, at least once.
Yeah, 2 times.
Yeah. So why don't you talk about how he does the news thing? Because I think that's like the brilliant way of handling the news.
Well, he does a combination. He's looking at the futures market, and what's reported. And when he sees that a bunch of people are on one side, specifically the retail, right? The speculators, he kind of looks, okay, here's what the institutions are doing. Here's what the speculators are doing. And when the speculators get very heavy on one side, and there's a news event that kind of reacts very differently from what you'd expect, that's where he says, okay, I've got a combination. I've got the right environment, in that a lot of people are on one side of this trade, and I also have a trigger being that news failure event. So it's a the news is helpful, but it's the reaction that the market does or the stock does, what have you. That's what's the most telling. So it's done well for him. So
I totally agree with that part of what he does, and that's kind of how we do it as well, as just looking at the news and what would be normal and natural with a particular news item, and if it does something different, that gives you a ton of information, and he does an excellent job with that, and so we'll see if Powell surprises us on Friday, or if we get something interesting in the FOMC minutes tomorrow.
Yeah. So a lot to be covering. If you want to get a few more of the historical charts that we covered, Mike and I on Friday, you can check out that SMT video. Of course, check out the SMT video every day because we're always doing our analysis of the markets. And then, of course, we'll be back next week. Tomorrow, I've got Jim Ropel on the podcast.
Oh,
So
wow.
that'll be dropping Thursday. For those of you that know Jim, you might not be surprised to hear he's bullish. Spoiler alert, so I know, so unusual, but yeah, we've got so much education here for you folks. So thank you so much for tuning in today, and we will see you next time. Take care, everybody.